Hello friends, welcome to Learn Easy. We will discuss solvency ratios in business. Now, let us see what the solvency ratios are. Solvency ratios are critical for evaluating whether a company can continue its operations and fulfill its debt commitments over an extended period. Solvency ratios measure the firm's ability to satisfy its long-term obligations. Many institutional investors have a look at company solvency ratios to determine the reliability of the company in terms of monetary benefits before investing in it. A company's ability to clear its long debts with the help of current assets is measured by the solvency ratio. Now, let us see the different types of solvency ratios. Types of solvency ratios are: first, debt to equity ratio; second, debt ratio; third, proprietary ratio or equity ratio; fourth, interest coverage ratio; fifth, financial leverage. Now, debt to equity ratio. The debt to equity ratio helps in comparing how much the company has borrowed and how much money the investors or owners have put into it. This is the ratio that considers the long-term debt and the shareholders' equity. It measures the amount of debt that the company is using against equity. It helps to know the balance between borrowed funds and owner's fund. So, debt to equity ratio is equal to long-term debt divided by shareholders' equity. If the ratio is high, then the company is mostly using debt, which is not good. This increases the overall financial risk. The company may have faced trouble to pay off their debts. If the ratio is low, then it means the company is using equity more. This is a sign of safety and stability, which makes a company good for investment. The acceptable debt to equity ratio varies significantly across industries. Some typical value of debt to equity ratios are: in technology and service sectors, debt to equity ratio is typically below 1 due to lower capital requirements and a preference for equity financing. In manufacturing and industrial sectors, debt to equity ratio is ranging from 1 to 2, reflecting higher capital needs for equipment and infrastructures. In utilities and capital-intensive industries, debt to equity ratio is typically exceeding 2 due to substantial investments in infrastructure and long-term assets. Second, debt ratio. Debt ratio aims to determine the proportion of the company's total assets financed by debt. Total assets mean which includes both current asset and non-current assets. So, debt ratio is equal to total debt or liabilities divided by total assets. In other words, the debt ratio evaluates the proportion of the company's assets that are financed through total liabilities. If debt ratio of a company is high, then the amount of liability is higher. This means that the company do not have sufficient assets to pay off debts. This is a risky affair which shows inefficient management. If the debt ratio of a company is low, then it means the company is investing more in assets. This means the company has a sufficient amount of assets to pay the debt when needed. This shows slow dependence on borrowings and safety. The acceptable level of debt ratio varies by industry, reflecting different capital structures and financing needs. In technology and service industries, debt ratio is typically below 0.5 due to lower capital requirements and a preference for equity financing. In manufacturing and industrial sectors, debt ratio is typically ranging from 0.4 to 0.6, reflecting the need for significant investment in machineries and infrastructure. In utility and capital intensive industries, debt ratio is typically exceeding 0.6 due to substantial infrastructure investment and long-term financing needs. Third, proprietary ratio or equity ratio. Proprietary ratio or equity ratio establishes the relationship between funds of shareholders and total assets of the business. It measures the share of shareholders' equity in total assets. It reflects how well assets are backed by owners' fund. So, proprietary ratio is equal to total equity divided by total assets. If you are new to my channel, please subscribe, share and press the notification bell. The higher the proprietary ratio, the lesser the leverage and comparatively less is the financial risk in business. A higher proprietary ratio indicates strong long-term solvency and financial stability. It shows that the company relies more on equity rather than debt for asset financing. If proprietary ratio is low, there is a question about financial stability. The amount of equity that a company should use is not there, which makes the business unstable. Fourth, interest coverage ratio. The interest coverage ratio shows how easily a company can pay interest on its outstanding debt using operating profits. This ratio helps in determining how many times a company can pay the current interest rates in their existing funds or current earnings. So, interest coverage ratio is equal to EBIT divided by interest expense. EBIT means earning before interest and taxes. A higher interest coverage ratio means the company can comfortably meet its interest obligations. This means the company has sufficient surplus to be in a good financial position and is capable of handling financial crisis. A lower interest coverage ratio indicates potential difficulty in servicing debt and higher financial stress. In this case, the company will not be able to pay the interest to the debtors regularly with the existing funds. If the ratio is lower, below 1.5, then it can be said that the financial situation of the company is not good. In general, an interest coverage ratio of 2.5 or higher is considered healthy. However, the acceptable level of the ratio can vary by industry. In technology and service industries, interest coverage ratio is typically above 5 due to lower debt levels and higher profit margins. In manufacturing and industrial sectors, interest coverage ratio is typically ranging from 2 to 4, reflecting higher capital requirements and variable profit margins. In utilities and capital intensive industries, interest coverage ratio is typically 1.5 to 3 due to significant debt levels associated with infrastructure investment. Fifth, financial leverage. Financial leverage is equal to total assets divided by total equity. This ratio aims to determine how much of the business assets belong to the shareholders of the company rather than the debt holders or creditors. The higher the financial leverage ratio, the higher the leverage. But this entails higher financial risk, as heavy debt obligations taken to finance the business assets. Solvency ratios play an important role in decision-making process in business. Importance of solvency ratio. First, solvency ratios help in identifying how the company is going to perform in the long term based on current finances and operations. Second, with the help of the solvency ratios, the board of directors can set up an adequate budget for the company. Third, adequate allocations of fund in different areas of business can be done to generate higher revenue. This is because the solvency ratios provide data about the financial priorities of the company. Fourth, financial risk can be easily assessed with all the solvency ratios. This helps investors in knowing whether to invest in a company or not. Fifth, investors use the solvency ratios to assess the company's ability to handle debt and make informed investment decisions. However, there are some limitations of solvency ratios. Limitations of solvency ratios are: first, solvency ratios consider the amount of debt the company has to assess its financial position. However, if we decide to compare two companies of different sectors, solvency ratios might not be the perfect criterion. Second, a company can have a low debt amount but mismanaged financial practices. Low debt can lead to a good solvency ratio, but this does not mean good financial condition. Third, different companies need varied capital based on their nature of business. A manufacturing company will always have a higher debt compared to the service provider company, but in this case, higher debt does not justify a bad financial position. Hence, the solvency ratio should not be the only criteria to look at to assess the company's financial position. The manufacturing company might have higher debt but adequate financial management. Having an adequate financial management process can surely boost their profits. Fourth, solvency ratios give a misleading picture if used alone without other ratios. Now let us conclude. Solvency ratios provide an important insight into the company's financial health and ability to satisfy long-term obligations. By examining the balance between debt and equity, these ratios provide crucial insights about a company's risk of default and overall stability. Debt to equity and debt to assets ratios are important tools for investors and stakeholders. Solvency ratios assist the investors in making sensible investment decisions with limiting potential risks. That's all. Thank you for watching the video.